Right now in Canada, thousands of people with stable jobs, decent savings, and credit scores that they've spent years building are getting their mortgage applications rejected. Not because they made obvious mistakes, not because they're irresponsible with their money, but because there are 5 invisible tripwires inside the mortgage application process that almost no one talks about until it's too late. And if any of these 5 things are sitting in your file right now, a bank rejection isn't just possible, it's almost guaranteed. Let's look at the hard data on this. Now, before we get into that, I want to be upfront. We're not talking about rate predictions, we're not talking about credit scores in the abstract, and we're not giving generic advice that you've probably already Googled. We're going to walk through the exact 5 reasons mortgage applications get rejected in Canada and touch on each one of them individually. I'm going to show you the specific math that kills your approval, and more importantly, what you can actually do before you ever walk in with a mortgage application to try and get an approval. Now, you might be thinking, Myles, I have a stable income, I've been paying rent on time for 5 years, my credit score is just fine. Why would I ever get rejected? Here's the problem. Banks aren't approving you based on what you earn. They're approving you based on what's left. After every dollar of debt you already owe, every single month, that calculation, not your income, is what makes or breaks your mortgage application. And right now, with the stress test still in place and affordability stretched to its absolute limit across Canada, the math is brutal. All right, the first reason catches more people by surprise than any other, and it has nothing to do with your credit score. It's called your debt servicing ratios. There are 2 of them, your gross debt servicing ratio, known as the GDS, and your total debt servicing ratio, known as the TDS. Your GDS measures how much of your gross monthly income is going towards your housing alone. That's your mortgage payment, property taxes, heat, and if condo fees, those are added in there as well. In Canada, that number needs to stay under 39%. Unless you have 20% down, you can sometimes push that with select lenders. Your TDS takes everything in the GDS and adds every other monthly debt payment on top of that. Car loans, credit cards, student loans, lines of credit, all of it. That total needs to stay under 44%. Unless, once again, you put 20% down and go with select lenders. And instead of guessing, let's run some actual numbers on this. Let's say you gross $8,000 a month. That means your total debt payment, mortgage included, cannot exceed $3,520 a month. On a $600,000 mortgage at current rates, your payment alone is somewhere around $3,200. Add a $400 car payment and a $200 a month student loan, suddenly your TDS is sitting at 47.5%. Your application is dead on arrival. Not because you can't afford it, because the formula says you can't. Math doesn't lie in these scenarios, and the lenders follow that math to a T. The second reason is one most people have heard of, but not many actually understand what it's doing to their application, and that's the mortgage stress test. Here's how it works. When a lender qualifies you, they don't use the rate you're actually going to pay. They stress test you at either the Bank of Canada qualifying rate of 5.25% or your actual contract rate plus 2%, whichever is higher. Now, you might be thinking, Myles, that sounds interesting in theory, but what does it actually do? How does it actually work? So let me show you some math on this. On a $600,000 mortgage, if your actual rate is 4.5%, the bank is qualifying you at 6.5%. That's a phantom payment. You will never generally write a check for it, but the bank is calculating whether you could survive if rates were to move against you. And that phantom payment of, let's say, $300 to $400 a month, higher on paper, is enough in some cases to push your TDS ratio over the line and end your application. The stress test isn't going anywhere. And to be honest with you, it proved itself quite useful when people went from record low interest rates to renewing at rates of 4 to 5%. And if we really want to get technical with this, you can actually use it to your advantage. Find out what the payment is that they used for the stress test and put that towards your mortgage instead of your actual payment. For 1, if rates go up, you're already making the payment. You're protected. For 2, you're paying your mortgage down faster, lowering your interest costs and shortening your amortization at renewal. And for 3, it's going to save you a ton of money in interest. Congratulations, I just saved you thousands of dollars. All right, this is where I'm going to give you something that most people don't really see or talk about. Everyone focuses on their credit score, 720, 750, 780. And yes, your score really matters in this case. But what the banks also look at just as much, and sometimes even more closely, is your credit utilization ratio. How much of your available credit are you actually carrying right now? If you have a $10,000 limit on your credit card and you're sitting with a balance of $7,000, even if you pay it every month, even if you've never missed a payment, you're at 70% utilization. Most lenders want to see you around 35%. At 70%, they flag you and they take a deeper look at your file. Not because you're irresponsible, because their models read it as financial stress. Here's the counterintuitive fix. Don't close a card, pay it down. Moving $3,500 in the right direction could completely change how your file reads. Another thing to keep in mind with this, with current rules and regulations behind credit cards, if you carry a balance of 30% of your limit or more month over month, your score will actually start to go down. So making sure you're under that 30% threshold can be very, very useful, not only for your mortgage application, but for that credit score we all care about so much. Now, number 4 catches a lot of people off guard, especially first-time buyers who've been saving diligently for years. The bank doesn't just want to see your down payment. They want to see where it came from. They want an actual paper trail. If a family member gifted you $50,000 cash and it landed in your account last month, the bank is going to ask you for a gift letter and proof of that transfer. If you sold a car or cashed out an investment, they want documentation. If the money can't be clearly traced or shown to have been in your account for the last 90 days, it's going to raise flags and they're going to request documentation to confirm the source of those funds. And that flag can slow down the process of getting an approval, or sometimes even kill your application. Your money needs to have a story. Showing up with a lump sum and no documentation, that's not a down payment to the bank. That's a big red question mark. And the 5th one, this one hits a lot of Canadians who've built something for themselves. If you're self-employed, a freelancer, a business owner, a contractor, the bank doesn't use your gross revenue to qualify you. They use your net income. That number that after every legitimate write-off your accountant has claimed for you. And here's the brutal irony. You spent years working with your accountant to minimize your taxable income. That's smart tax strategy. It keeps more money in your pocket. But that same strategy is now being used against you because the bank looks at the net income number and says, this person doesn't earn enough to carry this mortgage. Someone shows up with a 20% down payment, a profitable business, $200,000 in assets. Well, they're still getting rejected in some cases. Not because they're not financially strong, because the paper math doesn't work with what the banks want it or need it to say. If this is your situation, stated income programs and alternative lending solutions exist specifically for self-employed Canadians. This isn't a fringe product or a private product with crazy interest rates. It's a mainstream solution that a growing number of buyers in your position are using right now. As a mortgage professional that's been in the industry for 15 years, I've seen a lot of self-employed people go through this. I've seen people who hold corporations and corporate accounts and pay themselves very little because they pay less tax on the corporate side. It makes a lot of sense. And for them, commonly, they're happy to take a higher interest rate and in some cases a lender fee because in most scenarios, the extra cost of that interest and the lender fee equals out to being less than the amount of taxes they would pay if they claimed all their income through their personal income versus the corporate income. Most people think mortgage rejection means come back in 2 years. That's just simply not true. The majority of mortgage rejections are, for one, preventable, and for two, usually don't mean you have to wait 2 years to come back. But this only really factors in if you know about them before you apply and you tackle them early. There's a 60 to 90-day window before your application where 3 specific moves can completely flip your approval odds. Move 1, pay down revolving debt before you apply. Not to zero, but making sure it's under 35% utilization. That single move can shift your TDS ratios by several points and change the way that lenders see your credit application. Move number 2, if you're self-employed, work with a broker who knows how to document your income for specific lenders you're applying to. The wrong lender for your income type will say no. The right one will often say yes. And if you know where to go, it saves you a whole bunch of time. Move number 3, if you're rate shopping, do it within a 14-day window. Multiple credit inquiries within that 14 days counts as a single hit on your bureau. Outside that window, each of them generally costs you some points against your credit score. Or, alternatively, work with a mortgage broker who pulls your credit bureau once and works with around 60 different lenders. That way, for one, you don't have to shop. For two, you don't have to worry about your credit bureau being pulled repeatedly. Just makes sense in my opinion. The point of this video isn't to scare you. It's to make sure you're not walking into a mortgage application blind and coming out with a rejection. Now, if you want to see the hidden costs of buying a house, you can click this video right over here where I deep dive into that. And if any of these 5 things sound familiar, if your debt ratio is high, if your down payment just arrived, or if you're self-employed and not sure how your income reads on paper, there's a link in the description down below where you can book a call with me and my team. We'll do a full application audit before you ever need to formally apply for a mortgage. There's no pressure here, there's no obligation. It's just to try and provide clarity on exactly where your file stands and what needs to be done for your greatest success. My name's Myles Nowik, owner of the Nowik Mortgage Team, powered by Indy Mortgage. And if you got value out of this video, maybe think about hitting that like and subscribe button so more people like you can see it. Thanks so much for tuning in. We'll catch you on the next one.